Risk management has again been a hot topic of discussion at Cybos this year. What do you see as being the major trends?
Yeah, categorically, probably the same kinds of drivers and trends we're seeing across the whole FI space. But we take a look at social, technology, economic, and regulatory. On the social and the technology front, I put those together from a social networking perspective. We're seeing, incredible proliferation in everyone's access, online access to accounts of value, right? So there's 30 billion connected devices out there today. That's 4 times the world's population. That's projected to go to 50 billion by 2020. So we're seeing an incredible opportunity to personalize financial services, and it's counterintuitive because when it comes to remote access to accounts or remote interactions with customers, you would never expect that the result would be an opportunity to personalize financial services like never before, but that's exactly what's happening. The challenge with that from a risk management perspective is we are giving people access to accounts of value anywhere, anytime, and that creates a financial crimes risk, which we'll come back to. On the economic and the regulatory front, one of the key challenges there has been the global financial crisis, and that's translating into global financial reform that we're seeing with Basel III, and really what we learned there was the siloed approach to risk management practices is not going to work, going forward. And it wasn't so much the case that the current practices, any one of them, or the current tools or any one of them were bad. We just had a lot of necessary but insufficient practices that were taking place. VAR is a great example. VAR is still a valid risk management tool, but it was over-relied upon, limited by historical data. It doesn't take account of tail risk. So some good learnings, going to translate into some financial reform here. Basel III is leading the way. We got quantitative impact analysis that still needs to occur there, but we're going to see a change in capital requirements carried by that apply to banks, and as well liquidity requirements going to be significant.
What challenges are banks facing in these areas?
Yeah, no, good question. One of the big challenges here is going to be margin compression. So as banks are required to carry more and larger capital and liquidity buffers, clearly that's going to have an impact on their margins. So the better job they can do of optimizing their use of capital and optimizing the regulatorily required capital and liquidity levels, better off they're going to be. The other challenge for them is one of reputational risk. So we talked about increase in financial crimes. Financial crimes are counter-cyclical, so as we've gone through this economic downturn, we've seen a spike in financial crimes. That creates reputational risk for banks, and if reputational risk manifests itself, you can then have that ripple into funding risk, deposit flight, and that can lead back into liquidity problems. So we think we've got some important margin compression challenges as well, some reputational risk challenges that banks are going to have to address.
Given the challenges of margin compression, liquidity problems, and the cycle you mentioned there, what role do you think technology can play in helping banks improve?
So technology is part of the answer, right? It's not an answer in and of itself, but there's definitely some things that I think we can do with technology that are going to help. And one of the issues here is, from a risk management perspective, we're going to need far more rigorous analytics around risk, measuring and determining appropriate capital levels. We've got to, rather than relying on pretty static ratios, we've got to take a look at rigorous scenario analysis and stress testing. We've got to take a look at correlation of risk factors. We've got to take a look at those risk factors as they apply across a variety of different risk categories. So our scenario analysis has to be done taking account of all those interdependencies, and that's a pretty demanding analytics requirement there, and so that's something that we can provide from a technology perspective. And as well, from an operational risk perspective, we can automate transaction monitoring. So when it comes to the financial crimes arena, the automation of processes around transaction monitoring, identifying suspicious transactions, and enabling the disposition of those investigations and cases is really increasingly important.